I'm Morella Fernandez. Thanks for joining us here on Market Call. Colin Cieszynski is on the show today. He's Chief Market Strategist at SIA Wealth Management. He is taking your questions today for technical analysis. All right, here's how to reach us. 1-855-326-6266 if you want to call in. You could also send an email, marketcall@bnnbloomberg.ca. Colin, thanks for coming in today. Markets recovering today. Where would you peg investor sentiment at this point?
It's interesting because it seems to be a little bit more optimistic today. But I think the big thing we've seen is we've been on a roller coaster ride for almost 2 months now with tariffs. And it's like one day Donald Trump goes running around threatening tariffs and talking about Independence Day and Freedom Day and then Liberation Day and
Canada 51st state.
And the 51st state and all kinds of things like that. And people get upset and markets go down. And then he kind of backs off a little bit and markets go back up. So we've seen this up and down from day to day, depending on what he said or what's rumored. And sometimes we've even had 2 or 3 swings in the same day.
So we've seen a lot of roller coaster activity today. As you mentioned, markets seem to be doing some recovering. Last I looked, TSX was at 370 points at this hour, almost 1.5%. The S&P's also got a return here of 1.65%, and the NASDAQ up about 2%. So is this sort of Monday morning calm is unusual, or it feels unusual?
It does, because usually we see this on Fridays. And last week we had, Friday was down almost the entire day and then just came back in the last half hour or so during quadruple witching hours. So it's possible that having had quadruple witching on Friday, that may also be helping to propel the markets a little bit today. Maybe people sat on their hands on Friday, but we do have some rumors out there that, well, maybe the U.S. will cut back on tariffs somewhere. We could have a tweet come out and the whole thing could change again.
Yeah, they won't be as grand as some had expected. So you've noticed that more investors are turning to international markets. Where are they choosing to put their money?
What we've seen over the last month or so primarily is North America and Australia have underperformed, and China has done extremely well, and Europe has done extremely well. And it's very interesting at a time when the U.S. is threatening tariffs against pretty much everybody, to see that there has been this significant movement in capital with Europe and China attracting capital flows.
Do you see that continuing, at least in the near term, because we still have that April 2nd deadline?
It would seem that way. I think we're seeing a lot of ups and downs, but this is kind of when we look at country level capital trends, we're looking over weeks and months rather than just a daily or intraday. So
okay.
There has been a sizable shift over the last number of weeks, and so it would seem that does seem set to continue, at least in the near term.
Yeah, and people are still sort of flocking to gold as that safe spot to turn to in times of trouble. Gold still well up. Do you expect that to continue?
So far, people are definitely seem to be seeing gold and silver in their traditional roles as safe havens in times of volatility. And we've got gold up above 3,000. We've got silver back up at 35, and they're continuing to run, and they remain well supported. We had sometimes it looks like gold wants to consolidate around 3, but then it just quietly keeps creeping higher, which makes me think that there's just steady flow of money going into it.
Got it. Okay, we're going to take a quick break to line up some phone calls. Colin Cieszynski, Chief Market Strategist at SIA Wealth Management, taking your questions today on technical analysis. We're back in a moment. Welcome back. Thanks for joining us on Market Call. We want to get right to your questions, and Andrew has emailed us. He says, could I get your technical analysis on Brookfield Core, whether you see it as a buy or a hold? What is your take on Brookfield? What does that look like?
Brookfield is a stock that, to be honest, we used to own in some of our portfolios until a few weeks ago, and we actually rotated out of it. We've seen weakness in financials lately. That's one of the areas that when we started seeing money coming out of the cyclicals, a lot came out of financials, out of industrials, out of consumer discretionary. So as this started to break down, as I say, we used to hold it, but we don't at this point in time, because we did have this fairly major breakdown in it. Now, what's interesting here with this was we had support on Brookfield about 78, and it broke it, and that was a pretty major breakdown. Now we kind of rolled back up into it. So far, so good. I mean, so that 78 support level should have become resistance.
Okay.
And having broken out through it is actually an encouraging sign. So far, it looks like it wants to bounce back. We do have this downtrend line here. It probably comes in 80, 82. See what happens when it gets when it gets around there. But so far, at least, it's looking a little more encouraging than it did a few weeks ago.
I just want to ask you, because it seemed to take that drop more sort of end of February, beginning of March. We saw a lot of the other stocks and the markets take a drop sort of mid or earlier in February, if not January. So what predicated that sort of later drop for Brookfield? Do we know?
Not off the top of my head.
Okay.
Like, I don't know if there was anything specific
that
to
triggered
it,
that.
But when Brookfield came down, there were a number of other financial stocks that came down all at the same time. So there was a general leg down in financials that Brookfield was involved
part
with.
of. Got it.
Yeah.
Okay, let's go to the phones. We have online John, who's calling us from London. Hi, John. What's your question today?
Hi, Marilla. Hello, Colin. My question's on KKR. It's doing all the right things fundamentally. It's buying back shares. It's paying down debt. It pays dividend, and it's positive. It beat consensus on 11 of the 12 past quarters. Technically, I did my own amateur technical analysis, and rather have you analyze that, I'd prefer your professional technical analysis to add to the fundamental. Thanks very much, Colin.
Okay, thanks. Again, so when we invest in stocks, we look at relative strength, and we look at the head-to-head battles between stocks and who's winning, and that's how we do a lot of our investing. And KKR is a stock that we did own towards the end of last year and the early part of this year. And as I noted with financials, as capital came out of the financial sector, we rotated out of a lot of our financial positions, and KKR was one of them. But so it has had this big correction that started at the beginning of February. And now it does seem to have picked up support here around that 110 level, which was similar to its August low, and it's starting to come back. So if we do start to see it kind of breaking out over this trend line at this point in time, technically it's starting to look encouraging.
Okay, so I'm just looking at it now. Is that 120.76 and moving up, I guess, today?
Yes, so probably this resistance would be here. We had previous highs in a round number at about 125.
Got it.
Would be the first resistance.
Okay, it'll be interesting to see if John came up with the same thing in his own analysis that he was doing at home. So let's move on. David's on the line. He has a question. He's calling from Ottawa. Hi, David.
Yes, hi. My question is on Enbridge. I would like your technical analysis on Enbridge for the long term. Do you own the stock? And thank you very much. Have a great day.
Energy seems to be holding, yes?
Energy has been holding. The oil price has been doing a little better. And the pipeline utility mid-caps part of energy has done extremely well. It's been more of the what do we want to call it, the midstream or the utilities. Those areas have done quite well, and they've held up actually better than the producers overall. So looking at Enbridge, you had a great run in the second half of last year. Right now, you're kind of in a bit of a sideways range between about 58 and 60. That is normal. That's a normal consolidation. It's not uncommon that we'll have something, especially something the size of Enbridge, that it can rally for 6 months and then it can kind of go sideways for 3 to 6 months digesting it. So this is not unusual. The stock's acting extremely well. It's very well supported, and it's picking up within its current trading range.
Got it. Okay, let's move on to another caller. Then Rob is calling from Calgary. Rob, what is your question?
Hi, thanks for taking my call. I'd like to, sticking with the pipeline theme, I'd like to hear Colin's opinion on Pembina pipeline. It's had a bit of a rally over the past month, and if you could offer your technical analysis, that'd be great. Thanks again, and have a good afternoon.
Thank you.
Thank you. So in the case of Pembina, again, it was one that had a really good run second half of last year. It has had a deeper correction than Enbridge, but if we look here, we can see that we've broken out of this downtrend here. You did establish some pretty nice support about 50, which again, going back was an old, more or less an old resistance level here somewhere 50-ish, and you've rallied out of it. You've broken out of a downtrend. So technically, that's been looking pretty encouraging. It looks like it's back under accumulation.
Yeah, you had the same one, I think, with Enbridge, where it was last August that it had that sort of downtrend before it started coming back up again.
Yes.
So, yeah, similar for Pembina as well. Okay, let's see if we can get another caller in before we have to go to break. We have on the line a call. Sorry, let me get. Joseph is calling us today. He's calling from Montreal. Hi, Joseph.
Well, we've talked about Enbridge and PPL. Let's talk about TC Energy. I'm going to put a slightly different spin on my question.
Okay.
So I want to learn if you have any particular metrics or studies you prefer over the others. TC Energy is actually looking good. It's piercing multi-year highs, possibly all-time highs. But there's some indicators like money flow and RSI that are running a little hot. So I was wondering your opinion on TC Energy right now, and if you have any favored metrics or studies that you prefer one over the other that would make or break a decision. Thanks.
Thanks. That's a really good question. And first of all, in terms of this, at SIA Wealth, we use point and figure analysis primarily, but I have looked at other things as well over my career. I often use candlestick charting and look at moving averages. I sometimes will look at Bollinger Bands, and I do look at RSI. And so if we are looking at, I don't have RSI on my chart at the moment, but sometimes I don't consider just going above 70 to be overbought, because things can be overbought and stay overbought. It would depend on the chart, which I don't have with me here. But let's talk about the chart again. This is one that had a really great run, and it's basically gone sideways for the better part of 4 or 5 months, which was pretty good. And now it's actually breaking out, and that is quite positive, because it's had lots of time to digest here. So let's call that 63 to 68. So it's having a really nice breakout here.
So for energy, you mentioned also for Enbridge that 5 or 6 months it does tend to go sideways. Is that generally for many of the energy stocks?
It's general. Actually, it's more generally in general.
Okay.
So you can see that across a lot of different sectors. It's not specific to energy, but it is more. You do see a lot in large cap stocks. Yeah,
because they had that spike you mentioned over sort of 5 or 6 months before it started going sideways, and you said it was digesting that.
Yes.
So that's not unusual.
Absolutely, that's not unusual at all.
Got it. Okay, let's take a quick break, line up some more phone calls for Colin. Colin's the Chief Marketing Strategist at SIA Wealth Management. He's taking your questions today on technical analysis. Here's how to reach us. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back to Market Call, and thanks for joining us today. We want to get to your questions. Hugo has sent in an email and says, it would be great to get your technical analysis on Constellation Brands. Do you think this would be a good entry point? So we'll pull up the chart for Constellation Brands, Colin, and have a look at sort of where they are right now. Because a lot of people want to know right now, with the markets kind of down, is it a good time to sort of get in and maybe ride a wave back up? So Constellation at 178.54, over the year down 33%.
Yeah, this one is actually intriguing to me, because we did have this big sell-off back in January. But if we look, we kind of had a low in January. You had a lower low in February, and now it's kind of trying to establish a higher low in March. If it can hold 175, this is what we call a reverse head and shoulders pattern. You have the two shoulders and you have the head, and that is actually right now looking like a pretty strong technical base forming. To make sure, to confirm that it is, you need to see this breakout. That's probably 185, 190. You'd want to see it break out of that to complete the base, but so far it's looking pretty intriguing here technically. On a relative strength basis, Constellation is still fairly weak. It's probably a result of the sell-off that it's had and the underperformance that it had over through much of 2024.
Okay.
But if this starts to base out and break out of this base, it could look really interesting.
So that's a reverse head and shoulders, meaning
Yes.
the head goes down and you still have the shoulders, and it would climb back up after that is the expectation?
Yes.
Got it. Okay.
If it breaks out. If it doesn't break out, then it was just a consolidation in the downtrend. But that's why on this one you watch for the breakout. But you usually don't see it till the right shoulder forms, which it seems to be trying to do here.
Okay.
And so if it can still hold this 170 and we see it start to bounce and say starting to go through 190, head for 200 could look really good.
Got it. Okay. Let's go to the phone calls. Elliot's on the line from Hamilton, Ontario. Elliot, what's your question today?
Please, your evaluation of Live Nation Entertainment, and where is the 200-day? Thank you.
Okay, I do not have the 200-day average on my chart here, but if someone could let me know, I'd appreciate it. On the interim, this stock, again, we have a lot of stocks in the U.S. and even in Canada that, as we've seen and already been talking about, that look a lot like this, that had a massive rally between August and January, February, and then we had this big tumble, and then it's been a matter of how much has it tumbled, but can see so far it is skinning support and starting to come back. So we're keeping an eye on this as we go forward. I mean, Live Nation clearly is is one of the bigger names in the consumer discretionary. It's we all want to go to concerts, but we 116. Okay, sorry, the 200-day moving average is $116. So actually, if I look at this chart here, it looks like it almost bounced right off it. So that's actually pretty encouraging in terms of that holding and certainly back above it. So it is a discretionary name. It's a cyclical name. And because of that, we saw that when the discretionary stocks got hit, this one got hit quite significantly as well. But so far, it's bouncing back.
I was wondering if you have concerns about discretionary spending for consumers, given the uncertainty of the times, given the temporary pause that could happen in the U.S. is the way they're referring to it in Washington. Mm-hmm. There has been suggestions of a recession, if only a slight one. And do you worry about that hitting stocks like Live Nation?
It's a possibility, and we saw it over the last few weeks in the retailing sector. And interestingly enough, it wasn't even just the cyclical retailers. It was even the defensive retailers like Walmart and Costco got hit really hard in the last few weeks as well, and as well as the cyclical names. So it's it suggests that people were getting really concerned about consumer spending, and as you mentioned, with good reason. It's not just the uncertainty surrounding tariffs, but there's been a huge slowdown in government spending, and that is still going to take money out of the economy, and we're seeing it in things like we've had profit warnings from the airlines. We had that big profit warning from Nike last week. So it's pretty broad based in terms of consumer spending. It's not just the most cyclical or the high end ones. It's pretty much everything.
Yeah, people are a little bit nervous and maybe being a little bit cautious, I guess, at this point. Okay, let's go back to the phone lines. Kevin's on the line. He's calling today from Kingston, Ontario. Kevin, what is your question for Colin today?
Hi, Colin. Thank you for taking my call. My question's on the TD Bank. It's had a good run the last 3 months. I'm just wondering if it's topped out, or would you continue to add to it right now? It's, I think, 86 and change. Thank you very much.
Thanks. So, generally speaking, with financials, actually TD has held up fairly well, all things considered, because in general we have seen capital rotating out of large cap financials, certainly out of the big cap U.S. banks. Have taken quite a hit in recent weeks. So TD here is bumping up against a resistance level close to 86, and it seems to have established support with that December retest around 74. So you're kind of in, if we look at a year, we're in this 74 to 88 range. We're right at the very top of it almost, and now we're waiting to see if it goes through or not, in an environment where, as I said, some of the financials have started to struggle. So we've got to, this one looks like it could go either way at this point.
Yeah, and TD in a special circumstance, right, where it had to pay the penalty in the U.S. and was bouncing back from that, and sold Schwab as well. So they did well by selling Schwab and maybe getting a bounce back from there?
Yes, I think so at this point. Yeah.
Okay, let's get to Sal. Sal's on the line calling from Toronto. Sal, what is your question today?
Hi, Colin. My question's on Celestica. I was hoping if you could take a look at that, and if you can also comment on, is there like an optimum way when it comes to technical analysis of the time frame to use? Like, do you ever use an intraday analysis when doing technical analysis, or is it only like months, like 6 months or a year or out? Thanks so much.
Yeah, great question, because it's one of those things people want to know what you're looking for, how long a period, what do they use in assessment? How do you determine that?
Honestly, it depends on your investing time frame. So people that are day traders might look at intraday charts, but if you're not a day trader, then don't, because it tends to be more distracting and psychologically upsetting than anything else. You can get really caught up in it. So you need to think about your time frame. If you're going to be a long-term investor, then you want to be looking at kind of longer-term weekly charts. If you're let's say a swing trader, of somebody who's going to trade a few weeks to a few months, then you want to look at daily charts. And really the hourly charts and down to the tick charts really are really for more very short-term oriented traders. So it depends on what your time frame is. But at SIA, our hold periods are 3 to 18 months. So we look primarily at daily charts.
So you do? Okay.
We do. At SIA, we do daily charting. And so I look here at Celestica, and yeah, this one, Celestica has been it's been an extremely volatile chart especially since the beginning of the year. Like second half of last year, it did absolutely awesome. And then it had that big sell-off that in January that had nothing to do with it, where it went down 30% in a day because somebody in China came up with a new AI platform. Right? And then we had this recovery bounce back. But what is concerning, though, is that we have subsequently saw Celestica take a big tumble. And it wasn't just them. It was all the stocks that had benefited from that whole AI boom.
Absolutely, all
story.
the tech stocks. Yep.
All of them. So and even now in our rankings, Celestica, to be honest, right now is down near the bottom of our rankings, relative strength rankings in Canada, because it's been hit so hard. But so is Nvidia, and so is a lot of the other names that were market darlings in 2024. And it's trying to come back. So far, so good. We'll see. As I mentioned, it's extremely volatile.
Got it. Okay. We are going to take a quick break. When we come back, we'll take a look at Colin's past picks. That's coming up in a moment. Stay tuned. Time now for past picks. Colin is here to go through them with us. His last time here was in November of 2024, the end of November, the 29th. And at the time, his first pick was BMO S&P US Midcap Index Series Units ETF on the TSX. At the time, it was 50.83. Now it's down to 46.17. So a 9% drop, return and total return 9%. What happened to this ETF?
What happened there was when we were here in November, the market was rocking and rolling, and it was still in the post-election honeymoon, and the bull market was finally getting down into the small and the mid-cap names. And they had a run for a while, and then it just kind of petered out. And as we saw sentiment change coming into this year, we saw people were less enthusiastic about the small and the mid caps, and they retrenched to the more defensive large cap names.
Got it. So it's in transition from everything that has happened south of the border that's rippling out around the world.
Yes, absolutely. And we've seen it in what I call the risk markets, the places people go when they're enthusiastic, when they're looking for returns, when they're feeling confident, have struggled. So it's mid caps, small caps, Bitcoin, other cryptos. It's all kind of rolled into the same overall shift in market sentiment.
Got it. Okay, let's go to another pick from November of last year. And at that point, it was Manulife at 45.07, now at 44.36. So a 1% return, no change in total return. Manulife typically pretty solid, but it's been going a little bit down. What has happened with them?
It's kind of gotten caught up in the whole turning against the financial sector. Now, what's interesting with financials is that among that group, the insurance companies have actually held up fairly well. all things, or at least they haven't gone down as much as everything else. Where I mentioned we've seen big banks in the U.S. take a big hit in particular, whereas insurance companies on both sides of the border have, as we see here with Manulife, have just kind of gone sideways for the moment.
Why do you think they haven't taken as big of a hit?
That's a good question. I think the banks have a finger in every single pie. They're really, really tied into just about every single part of the economy. So when people start getting worried about the economy, they start getting worried more about loan losses. Whereas with insurance companies, their assets and liabilities tend to get matched over a longer period of time. So to me, they're usually more, their curves are flattened out.
A little more protected?
Yeah, protected and a little more defensive than, say, other parts of the financial sector.
Got it. Okay, let's get to your third pick from November of last year. It was Netflix, which has done really well. At the time, it was $886.81 American, and now up to $959.50, so an 8% return and an 8% total return. How has Netflix been able to buck the trend, I guess?
Interestingly enough, for the most part, until the last couple of weeks, the new media, social media stocks is one of the few areas in the market that had held up extremely well. Perhaps people are thinking that maybe they're not as impacted by tariffs as other parts of the economy. They've held up well. They've done extremely well. Yes, Netflix had a correction February, March, but it's already bouncing back from it as well. And so this is Netflix. This is Meta. This is a lot of those kind of names had held up extremely well when the cyclical stocks were getting hit.
Do you feel like perhaps people might not consider this discretionary spending anymore? It's almost like a must-have, these streaming services that are sort of providing their day-to-day feed?
Yeah, to a certain extent. I mean, I think for a lot of people, these have kind of replaced traditional TV, and people stick with it through thick and thin. And of course, Netflix is one of the ones that has come out on top in the streaming wars.
Yeah, and has been around a long time now. Okay, we're going to take a quick break. Colin Cieszynski is staying with us. He's the chief market strategist at SIA Wealth Management, taking your questions on technical analysis today. We're back in a moment. Stay tuned. Welcome back to Market Call. Let's go right to the phone lines. Gordon is on the line from Victoria. Gordon, what is your question today for Colin?
Good morning. We have 3 LNG export facilities coming to the BC coast. I see that as a catalyst for increased utilization and build-out of Keyera's infrastructure. How do you read the chart?
The chart's actually looking pretty good right now. It's you probably saw earlier in the show we talked about the pipelines, but energy infrastructure is the same kind of thing. It's actually been doing well lately. This stock had a great run through to about December. It had a correction, but it has since broken out of its downtrend, and it's working its way back upward. The initial resistance would be up around the previous high, up closer to 48. But so far so good. This is a nice breakout here.
Got it. Okay, let's move along to Ted, who's calling us from Hamilton, Ontario. Ted, what's your question today?
Good morning. My question is about the charts. I just got into using TradingView. I printed out the 25-year chart for the TSX, the 5-year, and the 1-year. So on the 25-year chart, we hit a peak in 2001, and then it dropped down and hit the bottom of the channel, 2003. 2008, we hit the top. 2009, hit the bottom. Went somewhat sideways between the middle channel line and the bottom channel line until we get to 2020, where we broke through the bottom of the channel, then came back up, hit the top in mid-21, and then we went and did a double bottom, but we didn't quite hit the bottom of the channel. And so the double bottom was mid-22 and 23, and now we're up and above the upper channel line of the 25-year channel. So going by the past 3 times that it's touched the top channel line, it's always come back down to the bottom. So my question is, looking at the chart, are we going to be in a bear market where we could possibly get down to about 1,800 or 18,000?
So some of this would be very specific to what has happened in the world, right? Like the pandemic and the financial crisis,
Yes.
where we took those dips that lasted quite a long time.
So we can see that if we look at the very, very long term, the TSX is in it is in a long-term uptrend. It's hard to say where it might top out, but as Morella mentioned, we have seen previous peaks have been tied to panics in the markets. So it's something we want to watch for, something we need to keep an eye on as we're moving into this period of uncertainty where we don't know if there's going to be a recession in North America or not. But it's something we're keeping an eye on, certainly. And you're right, we are getting up around this the high end of this long-term trading range. The TSX has had a good run up in recent months. And from here, there's a few ways it could go. I mean, it could continue to go up. But, I mean, as we've talked about, a lot of markets, after having a big run up, kind of go sideways for a while. And we are around this round number of 25,000. So it's possible. It's hard to say. We'll see what happens, how it goes from here. But so far it's been trending. It's like probably the TSX will have a pause at some point, but it's hard to say exactly when in the context of the longer term.
Got it. Okay, let's go back to the phone line now. Monica's on the line from Burnaby, BC. Hi, Monica.
Hi, thank you for taking my call. Just calling to find out if you think Martin Rea is a good buy at this time. I'll hang up and listen. Thank you.
Thank you.
Okay.
Go ahead.
Auto stocks are really struggling, and auto stocks are right at the epicenter of this whole tariff battle. And it's not even just Canadian auto stocks, it's U.S. auto stocks are doing badly too. So the answer is, one thing that we have found is that, and we watch for being caught, is what's called the value trap, which is something's gone down and it looks cheap, but it hasn't started going back up yet. We looked at a couple of things earlier in the program today that looked like they had bottomed out and were coming back up, but this one doesn't look like it's bottomed out yet. It still looks like it's in a downtrend. At some point, it might bottom out, but as long as we've got this tariff war going on, it's pretty hard to see how this one's going to get very far until we get some kind of a sign of progress. But as long as there's just people are firing pot shots at each other online, it's hard to it could be cheap. It could still go lower.
So you would wait until at least after April 2nd, which is that tariff deadline in Washington, to see how it reacts to that or what comes out of that before thinking about putting money in?
Yes, and it's something that the whole sector could take time to base build because it's been beaten down so much. And in fact, if you looked at the Canadian retail sales numbers that came out on Friday, the headline number was extremely disappointing. The ex-auto number was not that bad, which says to me that the auto sector must have been terrible.
Yeah, the auto new sales were bad and car parts were not good either, right? That's where we saw the drop. So
yeah,
indication of what's going on, I guess. All right.
Yeah.
Let's leave it at that for a moment. We are going to take a quick break and get more calls lined up. Back in a moment. Welcome back to Market Call. Let's go to Olivia. She's holding on the line from Calgary today with a question for Colin. Hi, Olivia.
Hi. Yes, Colin, thank you. May I have your opinion on Marvell, MRVL? Do you see the possibility of it getting through to about 83? The high today was 73.
Okay, thanks. Let's take a look at Marvell.
I'll take a look. So Marvell, like other semiconductor stock, has really tumbled in the last few months. And I mean, look at this thing, really rocked and rolled. Like it was at 60 in August, almost doubled to 125 by January, and it's really crumbled and been hit hard. So we talked about Celestica, we talked about NVIDIA, and Marvell is in the same sort of boat. So I mean, it's come down from 125 to about, let's call that, say 65. And so there is a possibility it could have a bit of a bounce here. Now, what we want to watch for is prior to it taking off, the old resistance level was 75. And so far, that has emerged again. Now, if it can break through 75, it would actually look pretty good. And yeah, it could take a run up above 80. The first key level to watch for is 75.
Okay, and if you're watching for 75, you're seeing if it sort of sticks around that and doesn't go down any further again?
Yes, and if it starts to break through, and particularly if we see volumes pick up, that would be encouraging.
Got it. Okay, let's go to Michael on the line from Stratford, Ontario. Hi, Michael.
How are you?
Good, thank
Yes,
you. What's your question?
Yes, I'd like your technical opinion, please, on London mining. Thank you. I'll hang up and listen.
Thank you. London mining.
London mining. So we don't own London in our portfolios, but we do own other gold stocks. So we own Kinross, we own Agnico, we own the BMO TSX Global Gold ETF as well. So and these are all top ranked stocks in their universes. So in the mid-cap Lundin Gold, also another one that's doing great in relative strength. The sector is doing great in relative strength. It's a highly ranked stock, acting extremely well. It's currently in an uptrend, and gold is trending upward. And yes, it's consolidated a little bit lately. Gold is kind of consolidated a little bit around 3,000, but right now, this remains in an uptrend. It's showing relative strength, and it's very highly ranked.
And most of that growth just came in the last 3 months. Again, the uncertainty and people being pushed to gold?
Yes, and as we see the price of gold rallying, some people go into gold itself, and more people, and people also go into gold stocks.
Yeah, gold itself being very expensive, I guess, so they choose the other ones. All right, let's go back to the phone lines. Michael, I hope that helped you out. We're turning to Michelle, calling from Cobourg, Ontario. Hi, Michelle.
Hello there. Colin, I'd like your expertise, please, with the Cameco stock. We hit 80 or just over 80 this year. Will we see it again? Thank you.
Okay. Cameco.
Well, Cameco has been in quite a wide range over this last year, from 50 to 85. So, and it had come off quite significantly between December and March. Is it possible it could get back to 80? Well, if we look at its previous was about 85, and that was about, if we call that 60, and half of that is 25, 1250, about 7250. And we can see that kind of 7250 coincides there, and that is what we call the 50% retracement. So if you have a move in the stock, and then the counter move can often be about half of that. So 80, it's hard to say technically. It has gotten there, but generally when you get if you have a trend and then you have a move the other way, it's often about half. So that seems to be technically closer to 7250, where we saw some resistance in early February.
So you think if it goes up, it'll hit about 72?
It would seem that way. If we were just seeing this as a correction, then we would expect that it could bounce back to about 70, 7250. If it starts to break through that, then that would suggest that you might be going back to retest the previous highs. But usually, as technicians, we're usually incremental.
Got it. Okay. Let's go back to the phones, and Jimmy is on the line from Welland in Ontario. Hi, Jimmy.
Hi, Colin. I'd like to ask your professional opinion about point and figure charting as to their accuracy, reliability, and perhaps you could give us an example of when you might be most useful. Thank you.
Can you just tell us about point and figure and what it is and what it's meant to show?
Absolutely. So most charts that we look at are based on time. They're what happened over a day, or what happened over a week, or what happened over an hour. And point and figure charts take out the time element, and they use price movement. And I'll start with, at SIA Wealth, point and figure charting and point and figure analysis is the foundation of every single thing we do. We are really big on point and figure analysis. And this is why, because you will move up. So we use percentage charts for point and figures. So you have what's called rows and columns. So each row is 1%, say, or 2%. And so if you're in a trend, you stay in the trend. And if you go up 2%, or let's say $1, sure, a dollar box. So every time you go up $1 in the trend, you add another row. And if you're going up, they're X's. So you use X boxes going up, and if you go from 50 to 55, you'll put in 5 X's. And then before you have it go the other way, which is a downtrend and a column of O's, you need what they call a reversal, and it's called a 3-box reversal. So if you go up, say you're going up and up and up, and you're in an uptrend, you need not just a 1-box decline, but you need a 3-box decline to tell you that there has been a real shift. So the idea is the trend is your friend until you have a decisive turn back the other way. And the idea behind this is to filter out the day-to-day choppiness, the day-to-day, we call them the squiggles, the little ups and downs that if you get too into it will drive people crazy. And it's to try and distill back down to the trends. So when we use point and figure charting at SIA Wealth Management, we use point and figure charts in head-to-head battles to determine where capital is going, where money is moving over the medium term, over the longer term, and to determine when we're seeing decisive changes in capital flow and not just small incremental things.
Got it. Okay, we do have to take a quick break. When we come back, Colin will share his top picks. That's coming up next. Stay tuned. Welcome back to Market Call. We have Colin at the desk, and he's sharing his top picks right now. The first one is Agnico Eagle on the TSX. Gold, of course, there. Why, or tell me more about why you hold Agnico.
Yeah, so we haven't had Agnico in our portfolios for quite some time. And in our Canadian equity universe, I talked about ranking the stocks by how they're winning the head-to-head battles. Agnico is number one. So it's literally doing the best out of all the Canadian stocks right now. And I know the gold producers generally are doing well, but Agnico is number one. We've owned it in our portfolios for several months. It's doing well. It's trending upward. Gold has broken through. $3,000. This has taken a run up at $150, and it's been doing very well.
And you anticipate that given the uncertainty of the climate, it will either stay or continue to move upwards?
That's correct. Right now, it's continuing to outperform, and we haven't even seen, we talked about reversal, we haven't even seen a $3 reversal on this thing in a long time.
Okay, let's get to your next pick then, which is T-Mobile. Why do you like T-Mobile in the U.S.?
We have seen a rotation of capital, as I said, into more defensive utility names. And interestingly, in the U.S., that includes the old school telecom names. We haven't seen it in Canada, but we have seen it in the States. And I talked about the Canadian ranks. In our U.S. rankings, T-Mobile is the number one ranked large cap U.S. stock right now. So it's been doing extremely well. It's just generally been steadily improving. And in this last month or so, when a lot of the cyclical stocks fell, this has just held in really nicely and been very well supported.
Is there any reason you can think of that Americans are treating that as utility and as a defensive stock, but Canadians aren't?
That's a really great question.
It just boggles my mind. Usually one goes one way, and a different market, of course, much bigger market there. Maybe there's still growth for T-Mobile. I'm not sure what they're into, but it's interesting that's one of your picks.
Yes, and the other interesting part was within communication. We talked earlier about Netflix and Meta, and one of the things we did see a shift in the last month was a bit of a movement in the correction from the let's call it the new media, social media names back to these more traditional names. But we'll see. I mean, we also saw Netflix is bouncing back, so we'll see how it goes.
Okay, your third pick here is BMO China Equity Index ETF. Why BMO China?
As we talked about in various points in the program today, international markets have done extremely well on a relative basis. And could you put this back to a little longer term chart, maybe a 3-year chart, please?
Okay, we'll try and get that up. Yep.
And because what we've seen is that China is a market that had been quite depressed for quite some time. And it has finally started to break out, and it's been very strong in the last month or so. So I wanted to note this and just to highlight that we are seeing capital moving into international markets, particularly Europe, particularly China. I looked at Europe and charts for ETFs for Europe and China, and I went with this one because it was higher ranked and it looks amazing on the breakout.
I'm just wondering if you're concerned about China. I understand a lot of people wanting to invest overseas outside of North America because of the tariff situation and the threat that overhangs there. But China is also a focus for Donald Trump, right? He's already put tariffs on some Chinese imports, and with that April 2nd deadline, they could face a lot more. China is just one of his, he doesn't like the fact that they import a lot more from China than they export to. Yep. So they could get hit harder. Does that concern you when you're looking at an ETF in China?
Well, what interests me is that despite all of that, it's doing incredibly well. And even though Donald Trump has been threatening and threatening and threatening, and we've seen, and yet it's breaking out. And that's really intriguing.
Okay, so you mentioned international stocks or investments generally seem to be good right now. Talk to me a little bit about what you're seeing happen in Europe, if you don't mind. Because we talked about China. I'm just wondering if you're seeing that same sentiment of people wanting to go to other different parts of the world and where you're seeing that money go.
Sure. So in Europe, we have seen some capital going back into it, not to the extent that China was, because China has been more depressed. So it was really, really depressed for a long time. So we are getting this new visibility, relief rally kind of breakout. Europe has been more steady Eddie. It's just kind of been quietly climbing, but it has held up fairly well. And
you have a shorter term period for your investments in mind. If people are going shorter term, then you would say China, meaning sort of 6 months to 18 months, and maybe longer term for Europe?
Yeah, I mean, so far China is the one that's been acting well in the shorter term, but Europe has held up quite well as well. But it might not go up as much. Historically, it hasn't gone up and down as much as China has.
Okay, and if you're watching China, what are you watching for in the 6 months to a year kind of thing?
That's a great question. Right now, I've been looking more at the broad-based index, but we've seen broad strength. I mean, we've seen a lot of the consumer names, the tech names, have been doing fairly well. I haven't followed their infrastructure names as closely, but on the consumer tech side, the big names, the Alibabas and JDs of the world have been doing quite well lately.
Yeah, and some of their cars could do really well with Tesla being on the dance line the way it has. All right, we do have to leave it there. Colin Cieszynski is our guest today, joining us with his technical analysis. Thanks very much for coming in. And we'll see you again tomorrow on Market Call. Thanks again for joining us.